So what's there to discuss in price to book value? Everybody talks about price to book value. So what's new in this? If you see for a stock, the book value remains fixed while the market value, which is the stock price, is the value that gives us the current value of the asset. For a stock, the book value remains fixed while market value gives us the current value of the asset. So with time, book value will show an underrated value of the company's assets, much lower than the actual market value of those assets if those assets were to be sold today. In the sense, if you take the case of D-Mart, Avenue Supermarket, as you know, majority of their stores are built in the land they already bought. Since years they have been buying plot, and the buying price of the plot, that value will be added into the book value of the stock. But as you know, the real estate keeps appreciating year on year, sometimes lower, sometimes very high. So this appreciation is not coming into the book value of that stock, because as per accounting practice, book value will be the buying price at that particular year. Even though it appreciates over years, it is not mentioned or added into the book value. So if you see the price to book value of Avenue Supermarket, that is the D-Mart, as I speak, is around 22. So this value, even though it seems to be very high, like it is 22 times more than its book value, it is not actually accounting for the actual real estate assets the company is holding, because it is only considering the buying price of that particular real estate and not the appreciation which the real estate is having since the year it has been bought. Considering this unfairness in accessing the right book value, a price to book value of 3 or less is also considered fair for an decision making to buy a stock. However, keep in mind that this is not a very reliable ratio for all kinds of businesses and is just one of the ratios you can probably look into. This price to book value is only useful when you are looking at capital intensive businesses or financial businesses with plenty of assets on the books. The book value completely ignores intangible assets like a company's brand name, goodwill, patents, and other intellectual property. Book value also doesn't carry much meaning for service-based companies with hardly any tangible assets, like in case of TCS or other IT companies.